What is volatility? Volatility. It's a word you hear a lot when it comes to trading, and even more so when talking about crypto, with its reputation for huge, rapid rises and falls in price. But what exactly is volatility, and why is it important? How is it measured? And what can you do to take advantage of it as an investor or trader? And lucky for you, I'm going to be tackling this plus more in today's video. All right. What's up, everybody? This is John Doe here with Currency.com. And today we'll be familiarizing ourselves with a term that pretty much most of us probably use on a daily basis. But in reality, we got no idea how it's measured or even how it's calculated. But before we jump in, quickly give this video a like, thumbs up, and subscribe, and make sure you hit that notification bell so you are notified and never miss more of our videos. All right, let's get into it. First things first, it's important to understand why volatility is an essential concept across all trading. Volatility is described as a statistical measure of the dispersion of returns for a given security or market index. Yes, I know that might sound a little bit too complicated. Let me simplify things a little bit. Volatility represents how large the price swings of an asset is over a period of time, usually anything from 10 to 180 days. A big price swing means it's a highly volatile asset, and a small change makes it less volatile. And if there's no volatility, there wouldn't be any movement in price. And come on, that is obviously what you don't want when it comes to investing or trading. Wait a second. So clearly we should all just invest all in those highly volatile assets so we can see those massive gains and profits? No, that's wrong. I think higher volatility just means the swings in the price are bigger, but that doesn't guarantee you the gains and the price going up. They could just as easily massively drop. So you might hit the jackpot, or you could be left with pretty much nothing. Basically, the higher the volatility, the higher the risk. Now moving on, we got the definition out of the way. Now to explain why volatility is an important consideration for all traders and investors. Your trading and investing strategy determine what assets you choose and how volatile they can be. So you got to think, are you a more conservative investor looking for long-term returns? Then investing in a less volatile asset or group of assets might be your best way to go. Now, however, if you are a day trader looking for quick returns and you don't mind playing it loose with that nice high risk, then an asset with high volatility, that just might be right for you. Let's take Bitcoin, for example. So Bitcoin is considered an extremely volatile asset by, let's say, most traders. Its price going up and down with those crazy extremes, even more than a roller coaster that you would pull up on at Six Flags. We've seen the price of Bitcoin explode over 20% within a day, and just so it can crash 25% the day after. Now, this extreme volatility makes Bitcoin a playing ground for hardcore gamblers and day traders alike who are looking to make quick profit, often using high leverage during trading. Now, gold, on the other side, seems like almost a more conservative asset in comparison, where a price swing of 6 to 7% in a day is considered extreme, and that is pretty much very rare. And gold is, by most experts, actually considered to be a safe long-term investment, and is often used as a hedge against inflation or as part of a nicely diversified portfolio. This one is quite straightforward. Your personal risk tolerance or risk profile determine the assets you choose to trade. If you are a high risk trader, You can build a portfolio of highly volatile assets like altcoins. Let's also add NFTs in there, where the daily swings can be even larger than Bitcoins. However, if your risk tolerance is low and it's down there, then building a portfolio of low volatility might be the better idea. And of course, no conversation about investing will be complete without mentioning diversification, where investors build a portfolio consisting of both low and high risk assets, lowering the overall volatility of the portfolio. But I think we got more on this in the next video, where we're going to go deeper into diversification and hedging. When you enter the market for a trade is probably the most crucial element of trading. And high frequency traders use multiple trading indicators so they can make an assessment about when the market will turn and how large the price movement could be. In times of high volatility, the price movement could be extreme. And yes, as we know very well in the crypto world, so these are great times for fast short-term trade. On the other side, long-term investors might want to invest when markets are more steady or even dollar cost average to lower their risk exposure. So that's covered how volatility can impact investment decisions. Now, how do traders and investors measure it? Well, there are two key metrics used when analyzing volatility. The first is historical volatility. Historical volatility, also referred as statistical volatility, looks at past performances of an asset, analyzing the previous fluctuations of its price to estimate future performance. The second metric is implied volatility, also known as projected volatility. Implied volatility is all about looking forward, and it's based on the market's expectations of price movements over a specific period of time. This concept gives traders a way to calculate possibility, and it's an essential tool used by option traders who bet on future prices of assets. And as the name suggests, it's implied. So therefore, past performance does not come into play. It is far from being an exact science, but it's trusted by many traders to help them make an educated guess of what the future price of an asset will be. And that right there is the metrics covered. But now I think it's time to have a look at 3 indicators that are used to help track volatility. The most widely used indicator that shows the current volatility of an asset is Bolinger Bands. This indicator consists of 3 lines, with the middle line showing a 20-bar moving average, and the top and the bottom 2 show a +2 and a -2 standard deviation from the center line, and that right there is the default settings. And when the 2 outer lines contract, that means volatility is low. And when they expand, that pretty much shows that volatility is high. Traders will usually open a trade when the price of an asset hits one of the extremes, expecting the price movement to reverse to the opposite direction. Essentially, when you use the Bolinger Bands, you are looking to trade trend reversals. You go long when the price hits the bottom of the bands, and you look to go short when price is hitting the top of the bands. If trading was only that easy though. The average true range measures the price range of the last 14 bars and averages the results. It is shown as a singular line. When the ATR rises, volatility is high. When it declines, volatility is lower. However, it does not necessarily indicate a trend. Just gives an idea of what kind of price movements you can expect at a given time. The Keltner Channel, this is actually one of my personal favorites, uses a similar concept, where the center line shows an exponential moving average, but the 2 outer lines are set 2 times the ATR above and below that center line. These bands also expand and contract with volatility, but instead of looking for potential reverses in the price movement of an asset, Traders use the Keltner channels to trade the continuation of a price movement. If the price of your asset breaks above that top line, you go long, and if it breaks below, it's time to short. And I know this all sounds easy using these indicators, but in reality, you have to learn how to use price action with the indicators. Well, that's my guide to volatility in trading. And depending on what kind of a trader you are, understanding it can help you decide when to enter a trade or to invest in an asset for the long run. And of course, I didn't cover them all. There are many more metrics that you should be looking at when you are trading. But remember to always do your own research, such as watching this video right now, including some solid fundamental and technical analysis. And guess what? If you need help with that, we got you covered right here on the channel. We got our videos right in the links. Now, I gotta say this, it's so basic, but never invest more on one trade than you can afford to lose, because these indicators make things sound easy, but when you're actually out there, trading can be that long-term battle. Now, if you like this video, make sure you do click that like button, subscribe to the channel, hit the notification bell, continue showing love. I'll see you again when the next video drops. See you next time. It's John here with Currency.com.